Welcome to video 2 in the series, How to Protect and Even Grow Your Portfolio in Any Type of Market. In this video, we're covering step 2 in the series, which is to avoid the biggest mistake most investors make, which happens to be poor investor behavior and emotional investing. Before we get started, please look through the disclosures and pause this if you'd like to look at it for any longer time. Well, as Warren Buffett says, investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. Once you have ordinary intelligence, what you need is the temperament to control the urges that get other people into trouble in investing. Now, most people, when they invest, they buy into bubbles, they sell during crashes, and most people do not have the emotional fortitude to just stick to their plan. So today we're going to be going through the behaviors that cause people to short circuit their plan and abandon it and chase returns and exit markets when they're at their cheapest, when after a market crash. And towards the end, we're going to go through what you can do about it. So let's get started. So why is emotional investing so bad? This chart here shows the returns of the S&P 500, inflation, and investor returns ever since Dalbar started its studies on investor behavior. As you can see, the average investor returned only 3.69%, and the S&P 500 returned 11.11%. That's a difference of 7.42% over the period. Basically, investors that invest in the S&P 500 don't get the average returns of the index because they perform many different trades at the wrong times. So it causes this big performance gap. A lot of people call it the behavior gap, wherein investors earn less than the indexes that they're invested in. And this is not limited just to the S&P 500 or stocks. It also happens in bonds. As you can see here, the average investor returned 0.7%, and aggregate bond index for all of U.S. bonds returned around 7.7%. That's a gap of 7% in bonds, meaning that the average investor underperforms inflation, despite bonds being one of the strongest asset classes over the last 30 years. This graph illustrates the behavior of the typical mutual fund investor. The blue represents the buying and selling of mutual funds by investors. And if the blue is above zero, it means that people have bought into mutual funds more than they've sold. And if it's below zero, it means they've sold more than they've bought. The yellow shows the total market returns of the MSCI All Country World Index. And it shows the past 12-month returns. And as you can see, when the yellow line is positive, people tend to start buying after the markets have had a good run. So when the market returns are sufficiently high, people crowd into it. But when the market starts to go down and it starts to get into negative territory, people follow that. They don't respond to it beforehand, they follow it afterwards and start selling at the worst times when the returns, the losses, are the largest. And then they only start buying into the index after the 12-month returns start to turn positive. And you see this again and again. Over here is the tech bubble, and over here is the financial crisis. And it took quite a bit of time for people to get back into the index, making them lose a lot of money when we had these great returns over the past 5 and 6 years. So what we see are people, instead of buying low and selling high, as the old adage always goes, it's one of the things that most stock investors learn before they get into the markets. Investors buy high and sell low. So why do we do the exact opposite? Why do we do this? Well, it's actually pretty simple once we stop assuming we're always logical and begin to look at what drives our decisions. It turns out that we don't have one brain. We actually have three brains. And there's a theory called the triune brain theory, which states that we have three separate brains, all with different wants and needs. And therefore, much of our behavior can be understood by which brain is the dominant brain in the process. First, we have our instinctual brains, also called the reptilian brain. This is the brain that controls our fight or flight response and our feelings of fear when something is going wrong around us. Then we have our emotional brain, and this is also called the mammalian brain. And this is the brain that gives you all of the higher, more complex emotions like love and empathy and envy. Then we have our third brain, our logical brains, or our neocortex. This is the brain that makes us humans, and it's our ability to create tools, make beautiful art, and understand language. Unfortunately, this brain also controls our willpower, and because it came later than the other brains, we have a problem. Older brains tend to dominate newer brains. So the instinctual brain's needs come before the emotional brain's needs, and both of those come before the logical brain's needs. And this is what causes us to override our logical thought processes and make snap decisions. Now, the ability to override the thought process and just react is very useful when you're being chased down by a lion on the savannah, but much less useful when dealing with financial markets, for which our brains are very poorly adapted. And so, one of the things that gets us into trouble in financial markets is that stories appeal to our emotional brains, and we hear stories all of the time. We hear them in the news, and we have an emotional reaction to them. Because when we hear a story, our brain says, hey, it's story time. So we'll turn on a financial show, and the anchor and the guests will spin a narrative about how the market is doing. They'll talk to the expert of the week, who recently have made a great call about the market, but little is said about the records prior to that call, and they often cherry pick data to support their points. We then allow feelings like the fear of losing money or fear of missing out on a bull market to override any rational decisions we might make under other conditions. And that's why the advertisements that the networks air during commercial breaks are targeted based on the feeling the show inspires within you. You'll often see more gold and risk hedging investments when there are crises, and more growth-oriented advertisements when the markets are doing well. So the thing about stories is that they can be wrong, but they can feel right. So at the end of the day, few people keep track of the forecasts most investors make, and those that do keep track show how spectacularly wrong they are. There's a great study by Philip Tetlock over multiple decades with hundreds of experts that show how often expert forecasts are incorrect. But if a forecaster's story sounds and feels right and fits our mental map of the world, we assume it is right. And that's a big leap of faith, but it's taken all the time. This happens again and again, but people are terrible at remembering their state of mind the last time they went through it. So they're just doomed to repeat the same mistakes again and again. For example, people panicked during the recent market volatility in August of 2015, the Euro crisis a few years back, and most notably during the financial crisis when many commentators were decrying the collapse of civilization and saying buy gold and guns. Everything looks obvious now when you look back. Obviously, you should have bought at the bottom of the market and not sold then, but when you're going through the next crisis, you'll feel those same feelings of uncertainty and fear that were caused by any of the former crises we've all lived through. And it will always feel like this time is different. And many people will create compelling stories about why this time is different, but in reality, it isn't. It's just a different set of circumstances that generates the same feeling of uncertainty. We also suffer from cognitive biases. And this is one of the reasons why investors make so many other egregious errors. And biases are mental shortcuts our minds make to help us understand the world around us. And these shortcuts were very useful to our survival as a species, as they allow us to make snap decisions about the world around us. And again, this is very useful when that snap decision involves a lion in the nearby bush. But that same decision can be destructive when applied to the modern world, where anticipated hypothetical harm does not necessarily occur, and our response to that hypothetical harm damages our portfolio returns. So there are a number of different biases, and I'm just going to go through a few of them. First, we get to anchoring, and with anchoring, we tend to compare all future information to the first piece of information we learn. Basically, we overweight the importance of that first piece of information. For example, when you use the purchase price of a stock as the reference point for which you make future decisions, even if the purchase price that you purchased it for has no bearing on the future events. So when a stock plummets in price, people will often hold on to the stock, hoping for it to get back to even, because they value the stock based on its previous price, rather than the more logical scenario of reevaluating the stock at its new price and determining that it would be wise to buy or sell at its current price. This causes people to lose a lot of money when they're just trying to get back to even. And this bias also causes another bias called the underreaction bias, which causes people to take a while to assimilate information, new information, into the price of a stock, and say that there's a huge surprise in the earnings of a company, be either good or bad. Generally, the stock market takes a while to assimilate that information, so that leads to opportunities that people can take advantage of. So another bias is self-attribution bias, which involves thinking that good things that happen to you are due to your skill, and bad things that happen to you are due to bad luck. Simultaneously, we reverse this for others, thinking their good fortune is due to luck rather than skill, and things that go wrong are due to their lack of skill. For example, when someone buys a stock and it makes a lot of money, they like to think that it was their superior analysis that made them the money, rather than simply picking the right stock at the right time for a reason other than the reason the stock actually increased in value. Or if they have a big loss in a stock, they attribute it to the markets or some unforeseen bad luck rather than an error in their analysis. This is why a focus on the process by which we make decisions is important, rather than just evaluating by the outcomes. Another bias is confirmation bias, and confirmation bias involves only looking for facts and opinions that support your point of view. And this can lead investors to invest in different assets that have recently made money and out of investments that have declined, both of which cause trends to continue. So this is due to the fact that if you believe the market is going to continue doing well, you're more likely to read information from people saying the same thing. Think about it like, I have a feeling that the market's going to go up. Let's see what other people that think the market is going to go up, what is their reasoning behind it? And if that reasoning makes sense, you've just validated your own opinion, rather than trying to figure out why that opinion may not be true. So also, investors who use recent price moves as confirming their ideas about the future may invest more in the securities that have done well. And this helps to accentuate price trends that people were originally looking at. This will be a big part of why trends and trend following works so well. We'll cover that in a future video. Herding. People generally look to see what the crowd is doing and then they act for themselves, or they tend to act in a similar way to the same information. And this is a programmed response that has served us well in the past. When an entire group of hunter gatherers was running away from something, it was likely that something was life threatening, like a lion or a fire, and following the group kept you safe. In finance, this behavior tends to cause people to buy high and sell low during bubbles and crises. So we see herding behavior in individual traders, equity analysts' recommendations, investment newsletters, and even among institutional money managers. And John Maynard Keynes, the famous economist, has a good explanation for this. He identified herding among investment professionals when he noted that their prime directive is to keep their job. And an easy way to do this is to never be wrong on one's own. And a closely related bias to herding is feedback trading, wherein traders buy more because the market is rising. And as the market continues to rise, they continue buying more. And the market continues to rise because they bought into the market. So it's a self-perpetuating investment behavior. And we see it in both bull markets and bear markets. And this is why market declines often lead to further declines, and market increases lead to further increases. And if this behavior persists for too long, like in the late 1990s with technology stocks or in real estate in the mid-2000s, we get an asset bubble. Or during market declines, a market crash, like in 2008. Now, there are numerous other biases that we can go through, like overreaction bias, the disposition effect, recency effect, hindsight bias, availability bias, and many, many others. But let's save that for another time because I think you get the point. So, if our emotions are more than just slightly broken when it comes to the markets, what should we do? Well, hundreds of studies have shown that wherever we have a sufficient information to build a model, it will perform better than most people. That's from Daniel Kahneman, a Nobel laureate in economics who studied behavioral psychology as applied to the markets. And we can think of a model as simply a checklist, a programmed checklist that helps take the emotion out of decision making and help you move toward a proper choice. As a psychologist studying emergency checklists in aviation said, the goal is to minimize the need for a lot of effortful analysis when time may be limited and workload is high. So when you're overwhelmed, it's easiest and best to rely on a model, which is essentially just a systematized checklist. So let's look at models versus humans and experts. So two professors, and I'm going to butcher this, Lely and Filskov, did a study on diagnosing intellectual deficit due to brain damage. And in the study, they developed a model based on standardized tests of intellectual capacity and identified 83% of the out-of-sample cases they tested. And out-of-sample simply means it's outside of the original group that they developed the model on. And so that's how you actually test a model. So they decided to take this 83% accuracy and pit the model versus a group of experts. And they had some interesting results. As it turned out, both inexperienced and experienced professionals working from the same data underperformed the model, with 63% of inexperienced professionals correctly diagnosing the patient and only 58% of experienced professionals correctly diagnosing the patient. And you heard that right. The inexperienced professionals had better accuracy than the experienced professionals. They also posed the question, how would the experts do if we provided them with the results of the model? Well, the results were fairly shocking. When given the output of the model, as one might expect, the experts' scores improved. However, inexperienced experts only improved to a score of 68%, and experienced experts improved to a score of 75%. Both groups still significantly underperformed the model. Intriguingly, the improvement appeared to depend upon the extent of the use of the model. The model seemed to act as a ceiling to their results. Therefore, it was the construction of the model that mattered and not the judgment of the expert. This effect, where simple models outperform most experts, occurs in almost every industry you look at. And we're going to take a look at a few different industries throughout the rest of the video. So law is a complex field of study, and it doesn't seem likely that a computer model would be able to beat the analysis of experts. If you've ever read a contract, you know how complex legal language can be. But a study by Andrew Martin and Kevin Quinn called Competing Approaches to Predicting Supreme Court Decision Making attempted to pit a simple model for predicting the outcome of Supreme Court cases against the experts. The model looked at 6 factors, and among these were the circuit court originated from, and the political leaning of the lower court's ruling. And it took this model and compared it to a group of 83 of the top legal professors and practitioners in the country. The model beat the experts by a wide margin. It correctly predicted the outcome of Supreme Court cases 75% of the time, while experts only predicted the outcome correctly 59% of the time. Let's look at an example from finance. Several years ago, hedge fund manager and Columbia professor Joel Greenblatt wrote a book on how a simple, rules-based value portfolio could beat the market. The book, naturally, was called The Little Book That Beats the Market. After he announced the book, he launched an investing service that offered 2 options: a subscription-based self-serve option where people could look at the stock's output from the model and choose the ones they wanted, or they could have it done for them with the automated version that followed the model exactly, and they'd pay a fee of assets under management. The do-it-yourselfers earned 59% over the period, which sounds really good until you compare it to the S&P 500, which gained 63% over the 2-year period, beating the do-it-yourselfers by 4%. And before you start questioning the model, let's look at how those automated investors did. And the automated investors who followed the model exactly earned 84% over the 2-year period, which is a full 25% more than the self-managed investors, who failed to even beat the S&P 500. The conclusions from the paper were that self-managed investors avoided buying the biggest winners because at the time, those companies looked ugly. And this is due to the fact that value companies often do look ugly, and that's why no one wants them, but that also pushes their price down below fair value, which gives people a chance to buy bargains. That's value investing, but self-managed investors were short-circuiting the whole reason behind value investing by picking and choosing, because the self-managed investors tended to change their game plan after a period of underperformance. They also changed their strategy when both the market and self-managed portfolio declined, regardless of whether the strategy outperformed or underperformed the market. And they tended to buy more after periods of good performance, which we covered earlier as being bad for the business of stock investing. They were buying high and selling low. So if the investors had simply stuck to the outputs of the model and managed it just like the automated version, they would have done much better by not trying to outsmart it. But by trying to use their input to perform better, they actually performed worse due to the biases that humans have built into them. It was unavoidable without a good game plan. So, Bordeaux wine. This is interesting. During the 1990s, a Princeton economist and wine lover, Orley Ashenfelter, decided to create a model that forecast future prices of wine. And he was going to do this without tasting the wine. And most experts at the time, of course, thought he was crazy. But when you looked at the data, a lot of the botanists that studied different vintages, noted that vintage is affected by the weather. Wines are best when the summer is warm and dry, and that's they're also helped by wet springs, which increase the quantity of wine produced without much effect on the quality. So he built a model that used just a few simple inputs to predict the price of wine. And this is so important because small variations in the quality of the growing season caused huge changes in taste after, say, 10 years when the vintages started to become very valuable. And the taste difference and the price difference between one vintage and another vintage could be an order of magnitude difference between those. So he used three simple inputs: average temperature of the growing season, the rain at harvest time, and total rainfall during the previous winter. And surprisingly, but I suppose not surprisingly now after seeing these multiple models beat experts, we have a 90% correlation between the outputs, the prices that the model output, and then the prices that the wines would sell for in the future. Now, this greatly affected the wine industry, and of course, a lot more people are using his formula today. Many of you may be familiar with the movie Moneyball, and for those that aren't, in 2002, the manager of the baseball team, the Oakland A's, the manager is Billy Beane, wanted to reinvigorate the team, and like any team, choose players that won games. The problem was that he was on a tight budget in baseball terms, so he didn't have much to work with. So he turned to a novel approach at the time, and it was called sabermetrics, which was short for the Society for American Baseball Research, and it was the statistical analysis of baseball, and it applied rigorous statistics to how well each baseball player may do. Instead of looking at things like scouts traditionally looked at, like speed and contact of a player, sabermetrics demonstrates that statistics like on-base percentage and slugging percentage mattered much more to a team. They also began looking at college baseball players rather than the more traditional high school players, because the college players' Major League Baseball success was much higher than high school draft picks. So using this statistical model, this strategy based on rules-based process, in 2002, the Oakland A's spent only $44 million in salaries and were competitive with the New York Yankees, who spent $125 million that year in salaries. So as you can see, models beating experts is prevalent across almost every industry. So when we're investing, we want to use a rules-based process or a quantitative process. And quantitative is a fancy word for expressed or expressible as a quantity. And in the next video series, we're going to look at this in much more detail. But to summarize, what did we cover today? Investors are often irrational. We buy and sell at the wrong times because our fight or flight response and emotions override our logical brains. That helps systems perform better than human experts, even if they use fewer inputs than an expert may use, because systems are completely non-emotional and they're not influenced by human biases. So this leads us to the conclusion that we should probably develop a system to govern our investment decisions. And in the next video, we're going to analyze what the world's best investors do to systematize their decision-making processes. And that will be step 3, how the world's best investors use rules-based investing systems in their portfolios. If you have any questions about this video, leave a comment below this video on the page below, and you should receive the next video within the next few days. I will see you then.